What's up, guys? It's Cash Flow Cart. I'm a 22-year-old. I'm a dividend investor, and I started this channel probably been about a month now. And on this channel, I'm going to be sharing my own personal journey as well as lessons, maybe tips. And the goal is to create a community of like-minded dividend investors who seek to generate passive income through a dividend growth portfolio. So, without further ado, let's get into it. Okay, you read the title. This video is mainly geared towards, beginners starting their dividend journey. But if you're a year, if you're 2 years in, I am confident this video will still have, something for you. If you've been doing this for a while and all of this makes a little more sense to you, then I guess this video could just be good for entertainment value. Let's get into it. Okay, so what do you think is the best REIT that's a real estate investment trust and why? I'm 18 years old and I want to add O to my portfolio, but I'm not sure if it's the right move. Okay, so I saw this today and, this comment kind of sparked my initial inspiration for the video, not to address this ticker head on, but this is an 18-year-old beginning his dividend journey. This gets me excited. Okay. This kid's got a lot to learn, obviously. And, I wish him the best. But I see this often when you're starting your journey. You think that, you have to pick the perfect sort of, I guess, stocks, or in this case, REITs. You kind of have to create this perfect portfolio, and it's all about tickers. Guys, obviously, this is very important to have quality holdings in your portfolio. But if you're 18 years old and you're starting out, there's something that's going to be even more important, and that is going to make sure that you can commit to this game. Okay. Consistency, committing to not strategy hopping, not just giving up because you feel like you could generate better returns elsewhere. That's going to be, a huge setback to your wealth creation and your passive income growth. So, I personally do hold O in my portfolio, as I went over the position in my portfolio reveal. But, this comment was more interesting to me because this is an 18-year-old and, props to him for getting started. But, there's a lot more that goes into this. I guess what I'm trying to say is there's a lot more that goes into this than simply stock picking. It's going to be conviction to the strategy. It's going to be a long-term commitment. So, let's not go overboard on this, but there's the inspiration for the video. Okay. Should I sell my Apple and Microsoft stocks? These are two I also hold. Okay. I've got a position in both. And, for me, I think this guy's in kind of a similar situation I'm in, where he's seen that price appreciation. He has those capital gains unrealized on paper. However, as a dividend investor, it is so essential that you do not get tempted, to sell out, and you don't change your strategy into just being a trader, swing trader or position trader because you see some profits. I mean, with Apple and Microsoft both, since we're lumping them together, I think they have a lot of room to grow their dividend, both of them. These are both free cash flow beast. The yield right now is not the best, but in the future, I think this could be like one of the best yield on cost plays, for a lot of investors if they have a decent cost basis on these. So again, this just goes back to the beginning point. There's going to be a lot of temptation. You might think, oh, I should take these profits. I should start, trading, more actively managing my money a little bit. Guys, that is not the case. Okay. If you're doing this right, as you get more experienced, you're going to see gains. I mean, it's just going to happen because we're targeting always undervalued quality companies. And as those companies kind of come back to their fair value, the capital gains are going to roll in. So, don't change your strategy just because of capital gains. I guess that's the bottom line here. Here's my dog, Mia. She's kind of a pain in the butt when I film, but that's all right. If you've watched my channel for a little bit, you know that I kind of preach the, huge misunderstanding in the market kind of surrounding this JEPI or JEPI, this JEPI ETF. And, not to say that it doesn't make sense for some investors, I guess, later on in their career or later on in their life where they need that kind of immediate income. Maybe they need those bills paid and they want to generate income with the capital they have, or maybe they want to hedge against kind of a sideways market. I don't want to say there's no uses for JEPI, but I will say this, and this is pretty point blank. If you're a beginner, you should not be starting out with, funds like JEPI or QYLD. You should really be focusing on, mastering the basics, the fundamentals, finding undervalued companies, finding what metrics, resonate well with you, finding how you kind of want to determine when a stock is undervalued, how you want to go about averaging into it. Okay, guys, there's discretion in this game. This is not some plug and chug, buy JEPI, buy the popular ETFs. You're going to underperform in the long term if you're a beginner and you're wanting to just park money in some of these, covered call ETFs for the long term. I've got a whole video out about it, comparing JEPI to QYLD. You could probably easily find it on my channel, but I don't want to get into a whole other rant today. Beginners, true beginners, stay away from this ticker, please. Please. Moving on. Oh, I guess I included a little more because I did like someone's explanation of it, and I guess we'll get into it. Okay. So what's wrong with these ETFs? They're not blatantly wrong. Maybe they can serve someone somewhere, but for beginners, the ETFs have a requirement to generate the same income every month, approximately. It's not always the same, and that could be another red flag. Same income every month, regardless of how feasible that is. Okay? Investors would pull out if the funds reduced or suspended payments. This is a great point. Okay, now that JEPI has this higher trailing yield, there's pressure on JP Morgan's team, to continue these monthly payments. And with that, they're going to have to sell, I guess, call options that generate higher premium. In order to do that, these call options are going to have to be closer to, the underlying securities market price. And that's in turn going to limit upside potential a lot. Okay, if that didn't make sense to you, if that sounded like gibberish, I've got other videos out about it. Let's not get hung up on this, but, don't blindly follow trends. Please. Moving on. Okay. This guy said, hi all, 35, currently looking to get better at investing. First off, whatever age you are, okay, guys, whatever age you are, investing is not bad. Investing is great, okay? And I'm a firm believer that dividend investing can be a very profitable strategy, regardless of your age. Obviously, us in the younger crowd, I'm 22, we might be able to take somewhat of a yield on cost approach blended with some quality. Maybe people older on might have the approach of more current income. They might seek out starting yield a little more. There's definitely nuances, but regardless of your age, you're at the right place. That was cheesy, but I also put this in here because he said, I guess one of his screens, he wants a solid ETF that will earn me monthly yields. And I do want to stress, as a beginner in this game, especially if you don't need the income, right away, please don't focus too much time and attention on kind of the payout schedule. Okay. Don't say, I need something monthly or I need something that pays in these 3 quarters. I will say it is most popular probably for, stocks to pay out on, what is it, March, June, August, and December. Wow, my brain is slow, I guess. But, you know, don't take that payout schedule. So, do not rank that high in terms of your preliminary screeners. Instead, look for quality, look for valuation metrics, free cash flow growth, you know, sustainability of the dividend growth rate. Kind of, I've talked about it on the channel. It doesn't guarantee it's going to continue growing fast. Look at debt, look at the balance sheet, cash to debt more specifically. Again, I'll have content coming out about all this stuff, but if you're a beginner, don't worry so much about the payout schedule, especially if you don't need the income right away, which beginners probably don't. Moving on. I thought this was interesting. This guy said 2023 year to date, not the best for dividend stocks. And if you're a beginner, I want to caution you from kind of getting put in this basket of okay, dividend stocks. I need the J&Js, nothing wrong with Johnson. I need J&J, ExxonMobil, Clorox. I kind of need these old man stocks. Or you might tell someone your portfolio and they might be like, you got some old man stocks. Guys, dividend stocks come in, all cycles of, the company's growth. And I just thought this was interesting because he said not the best year for dividend stocks. And I get that, but you see Microsoft, you see Apple, you see Visa, JP Morgan, MasterCard, we could go on and on. And it's NVIDIA pays a dividend, but it's not really super committed to it. Walmart, Costco, Lilly, we could go on and on, guys. Dividend stocks, for my definition, are stocks that are in the dividend paying universe. Okay. So maybe when you're a beginner, you might feel some pressure to, look at the J&Js, the guys with huge track records, long track records. But, you can really get a blend of all types of companies. And over the years, you can really get a lot of diversification, without focusing on, whatever, the old man grandpa stocks, which I kind of felt a little called out by him saying dividend stocks here. But anyway, the other thing is being a dividend investor. If, a certain sector of stocks is underperforming and not having the best year, or, a certain style of stocks, that's very opportunistic for us. We almost like that. Like for me personally, we see here KO, that's Coke. I've actually started a position in Coke, this year because of that underperformance. I've seen more attractive valuations. Pfizer too. I was looking for it. I've started a position in that one, and that's probably one of the worst performers year to date on this. Okay, little bit of 2 cents there, a little bit of a tangent, but moving on. What else we got here for the beginners? Ford stocks. I liked this one because, if you've been dividend investing for any amount of time, you've probably, at least looked at Ford, seen maybe the yield was higher, right now it's cheap. And I'm not going to get on here and say Ford isn't a good company. I have belief in Ford long term. It's a mega cap at this point. But I will say this, and the reason why I'm personally not interested in Ford in my dividend portfolio is because of that, cyclical nature of the car industry. Okay. For me, in order for, a dividend stock kind of to pass my screens, I look for steadier free cash flow growth than Ford's going to be able to provide. I look for no dividend cuts or minimal dividend cuts. I mean, maybe if they've had a special case in the past, but I prefer no dividend cuts ever. And I prefer a steadier free cash flow than Ford could provide. Again, that's just my opinion, but I wanted to share it here. If you're a beginner, like as you go, you're kind of going to understand, how your brain or how you're wired as an investor. And I guess your discretion is really going to come through. If that makes sense. I hope I'm explaining some of the stuff well. I guess we'll see. JEPI versus JEPQ. This kind of goes along with the thing. He's like, okay, which one of these do I need? I don't know what this guy's personal scenario is. I don't know his net worth. I don't know his age. But again, following trends like this without really understanding the purpose of kind of these underlying ETFs, it's going to be very discouraging. It's going to, you're probably going to get out of this game if you see, a huge drop in your portfolio value. And then you realize with some of these income generating ETFs, they won't recover, to kind of your cost basis ever because of their aggressive, option selling strategy. I'll probably release another video. Maybe I'll talk about these differences, but the last JEPI video did well. Moving on. What is this? I mean, I guess this is not from, any sort of dividending community, but I do think this can bring up a good point. And I do feel, this guy might have been joking, but I do feel it sheds light on something. Calls on Tesla. He said they're making a bust now. I think early on in your investing journey, regardless of what type of investor you are, whether it's more growth, speculation. For me, at this point, I'm really in that dividend growth box. But I think early on, kind of news like this or rumors or, any sort of trends, you're definitely much more susceptible. You're definitely much more susceptible to kind of, getting excited about hype or news or something that comes out. We've seen it with a lot of stuff. Again, be careful. Focus first on numbers. Focus first on, we've talked about it again and again, free cash flow, sustainability of the dividend. And then, kind of the last thing you should be looking at after you've analyzed like trailing fundamental metrics, you've analyzed the mode of the company, and you've looked at the valuation currently for an entry. Kind of the last thing, if at all, you should be looking at is like, recent news or recent rumors, guys. With all that being said, I'm going to be dropping new dividend content kind of in this vlog style. I want it to be very real, very raw. And I'm going to be dropping new videos on Mondays and Thursdays. If you're already subscribed, guys, it's been awesome to see all the support, so early on. And I guess my YouTube journey, if you haven't subscribed yet and you want to, that'd be awesome. Otherwise, no pressure, I guess. Everyone take care.